Long episode. We all
Okay.
lost track of time.
Let me do this intro. Sorry.
Oh, okay.
Okay. So I'm the naive one in this episode, which is interesting position to be in when we're usually talking about technology and stuff. We're talking about finances, the U.S. economy, how things have shifted from companies going public to private equity, and I can learn quite a lot of interesting stuff. So if this isn't your area, I think you might find it interesting. I'd say like and subscribe, but we don't cover this stuff too often, at least not in this much depth. But it's super. Yeah, check it out. Enjoy the episode.
I have opinions. You're not used to hearing that from me. I know. I generally am kind of a non-judgmental, easygoing,
very unbiased.
Yeah,
especially when it comes to the UK US economy. Yeah.
Well, Peter, I think you shared this, so you have no one to blame but yourself. Fun story about private equity.
Sorry. I think I still can blame you, actually. At least by the end of this episode, I might be able to, yeah. But go on. I mean,
you can do whatever you want. You'll be wrong, but that's fine. Whatever.
Okay. All right. So getting into the opinionated...
oh, sorry. Did we start yet?
Yeah, I think you just did, yeah. Go on.
Man. So private equity is essentially what it sounds like. Non-public companies that invest in other companies. And the point of the article here is that private equity now makes up 1/5 of the total economic market, to the extent that in 1996, there were 8,000 firms listed on the U.S. stock market. Now there are fewer than 4,000. And the premise of the article is that companies are not going public because they can get more deregulated money from private equity funding.
Yeah.
But there are a long list of problems with private equity as an industry beyond just being unregulated. It can be very predatory, unsafe. It is completely unregulated, so there's no visibility. So I'm definitely not a fan. It's kind of the worst of capitalism.
I'm curious. Like in 1990, I remember the dot-com boom, and at the time, the IPOing, is that a word? IPOing?
Mm-hmm.
Was like the dream. That's the big thing. That was about how to get rich.
Yeah.
And every company in Silicon Valley was like wanted to IPO. How that wasn't that long ago though, right? I mean, those are like 10. I'm curious whether there was a bump at that point or something.
I think it just kind of coincides with the growth. They actually in the article talk about the trend starting in the 80s under Reagan.
Yeah.
And kind of accelerating through to now. 96, obviously, where the arc was really, or the curve was really starting to pick up. But I think fewer companies are doing that now because the incentive has shifted from going public to getting bought out.
Right.
So it's about
acquisition is the new hot.
Yeah.
Yeah.
So it's the mega companies which are kind of pushing this on us. Like you want to get bought by Cisco or Google or someone big,
or even just a competitor, right? Like, because a competitor can go to VCs and say, "Look how much more money we'll make if we acquire this company that does the same thing that we do."
Well, I know a lot of companies specifically start up with the intention of being bought by specific other companies.
Mm-hmm.
A few years ago, I remember a guy I met who had made a whole lot of money, and he sold like 3 companies all to Microsoft. My earphones have just gone. I hope you can still hear me. He'd sold 3 companies all to Microsoft, but specifically by starting. His business plan was to create a product that was close enough to one of Microsoft products that he couldn't get sued, but they would want to buy his company.
Yeah.
Interesting.
Great tactic.
Yeah. I'll just reset my
so a couple
seconds. Sorry about this.
The idea it's kind of a tough issue because the idea of private equity is like, people are free to invest in other people's companies. There's no problem with that. The reason we have a stock market was to regulate that kind of investment, but the protections it created were protections for the stockholders, not for the consumers. So when they're talking in this article how private equity is a problem, they're talking about how it's a problem for investors, not how it's a problem for the consumers. And so that's pretty frustrating. And some of the horror stories you hear about private equity are things like Toys R Us, where they do these like huge leverage buyouts. They put all the debt on the company that they purchased, put the money in their pockets, and then declare bankruptcy because they had never had any intention of paying that debt off in the first place. And you hear horror stories like that all the time. Sure, there are totally ethical private investors, no question about that. Is it a problem with the model? I don't know. What do you think? You're into the finance stuff, John. What's your opinion?
You make a great point, and I'm not very well versed in the unregulated, shadow realm of like VC funding and private equity, but I'm a little familiar. I just know that, after the 1929 collapse, right? That's when the SEC was created, right? In 1930 something. And it was to, like you said, it was to protect the stockholders and not the actual consumers of the various products that those companies were outputting. So like, and that's kind of worked now. Like, we saw it with what was that bank called in California? That
Silicon Valley Bank,
where the FDIC went in and took care of the holders first, and the investors second or third. I think that's exactly like what we need for this, because if I, as a company who don't know any better, have a star product and I get, cornered by a VC who promises me God knows what for a few $100 million, and then it actually ends up being that I signed a super fucked up contract. I feel like there has to be some sort of rules to this, because we're talking about such insane amounts of large amounts of money that it then can translate to affect, employees. It can affect the consumers. It can affect, a good example is that one robot company. I don't remember what they're called now, but they made these cute little robots that had really fun animations. They were on wheels, and what is it called? They went out of business and totally fucked the consumer. They just ran out of money. And they were charging $400, $500, $600 for this thing. Like, it was an expensive piece of technology.
Wow.
And then it just stopped functioning. And they went through this like bankruptcy and acquisition of assets, and then a different company picked up the technology and like tried to do good, but it didn't really work out. And this is exactly an example of how something like just funneling money into a company to make it explode super fast isn't actually a solution. Yeah.
And it's not,
which is why so many. Go ahead.
It's not all unethical. There are some really good, legit companies out there doing a lot of good work. So is it reputation that's spoiled by a few bad apples? I mean, certainly that's what they would argue.
Yeah.
But these are like really bad apples. So how many of them do you need?
And also, the problem is like, where's the money coming from and where's the money going to, right? China has a huge issue. We have a huge issue with Chinese VC money being funneled through America. Yes. And that's a really big problem, because that's circumventing the stimulation of our economy.
Yeah.
Completely. Right? Like, sure, they might pay X amount in taxes instead, but really what's happening is that they're making, I don't even want to know how many multiples to bring home to the Chinese market.
Yeah, that's a great point.
Very scary, and something I've seen personally. So, yeah. Go ahead, Peter.
I have a question. Why would any company actually choose to IPO over staying private? It seems like private has less regulations and, the money's there, it seems. So what advantages do you get? Is it just like public money?
Well, the first thing is, so when you make a company and you accept VC money, you accept investors' money, you are now sort of obligated to pay those investors back. Right. And you will negotiate with them as you take their money that they get 5% say, 10% say, 15% say. And slowly but surely you start losing control of your company. You might have majority, but eventually the scale might tip to where you don't have majority say anymore. And the investors can really press you and force you to IPO or force you to sell.
Or force you out of the company.
Or force you out of the company if they deem you're making bad decisions for the business. So my point is that if I'm an investor, if I'm a VC fund, and I gave you a company $400 million, let's say, right? Mm-hmm. And I know that if you IPO, you will be valued at a minimum of 800 million, right? I want my money back. And two, I want what was promised, whatever the multiples that was promised. So I'm going to push you to IPO so that we can make a bunch of money as an investor. I don't actually give a fuck about you. I want my money back.
Yeah. I guess my question,
I don't know if it's a choice between one or the other. I think sometimes, like John said, you take VC money to grow, and then once you get to a big enough point, you may decide then to either be acquired or have an IPO.
Okay.
So I think maybe the question more is like, why would somebody choose, have their strategy to be acquired versus IPO? But you can kind of do both.
And if you go read about the rules of IPO, you're totally right. It is turbo regulated. Like, insider trading is suspended for 6 months. Like, no one at the company can sell their shares for like 6 months. There's like all these rules to like making sure that the IPO goes through, and you have to like prove a bunch of shit to the SEC. And I mean, it's an actual nightmare to IPO. But once you do, right, once you go to New York and you get to cut the ribbon or whatever the fuck they do, like, you can make a lot of money. But you could also just sell your company to the next biggest or this, the bigger competitor and make just as much money as an owner. I don't mean as a company.
And there's some companies which are like reversing it, right? That they're going from public to private again.
Twitter.
I mean, that's what's
a perfect example. Yeah. Elon bought everyone's shares at a price that he claimed, I think, on a tweet, actually.
Yeah.
And he like valued it on a tweet, and then they used that in court to give everyone like $60 a share, which was way higher than what they had all bought in for. So he made a bunch of people millionaires. Like, thanks, Elon. But he privatized the company. He took a public company private. And then another thing that we didn't talk about, which is like, I think very respected, is a bootstrapped company. A company that grew from 0 to X with no external investments.
That's hard to do.
That's nearly impossible, but with the right product, it's very very possible. But it's so hard.
It's also it's a very US thing as well, I think. It's a very American thing that to take VC money. Like
to take the money.
The whole venture capital thing is I've never heard of it until America. I started talking to Americans, and the whole
look at the size of the U.S. economy. It's all financial games. Like it's shadow money. To answer your earlier question, Peter, about like when did the shift happen from everybody going for an IPO to going acquisition, I think probably related is in the article they say in the year 2000, private equity firms managed about 4% of total corporate equity. In 2021, it's 20%.
That's crazy.
This really has been a time of huge growth for private equity, and I think the idea that there's now half as many publicly traded companies as there were in 96, for example, investors are always going to make money. They'll figure out how. But it has significantly changed kind of the nature of the stock market to have 20% of the entire market, half of all companies, not be publicly traded, when since, as John said, the Great Depression, stock trading and mutual funds and all that have been kind of like the means of investment. Now it's becoming much more cloudy.
It seems like
and unregulated.
Previously, there weren't enough entities or like individuals or organizations or companies which had the kind of purchasing power to go around buying companies all the time. And it used to be just the public who collectively had that kind of amount of money. And that's why you would IPO. If you wanted to make a lot of money, you would sell your company to the public and sell your shares to the public. But
and
now,
it's like a win-win, right? Because I get to run my company and I make a bunch of money and I don't lose my company, and a bunch of other people get to make a bunch of money. So it's like everyone wins was the idea, besides the bigger fool, which we don't have to go into. But yeah, go on.
But now it's that I've heard a lot about the divide between the rich and the poor and the billionaires and the rise of the billionaires. Now there's just more of those. There's more mega companies, more giga companies,
and
it's sort of
This is related directly to the real estate issues that we have, because these same private equity firms are buying up huge amounts of real estate.
Oh, this is where you lose.
It's actually
me, man.
really interesting because there is a finite amount of people and organizations who have this amount of money, and they all deal in everything. So the reason that the reason that we just had a huge boom end with startups, right, and tech companies getting funding. So one, it was so easy to make money through money that you didn't own, because of the government loaning out money at near 0 or 0% interest in America. So these VCs, to clarify, these VCs were taking money from the bank basically for free, shuffling it into 100 startups, and only one needed to hit big for them to not only pay the bank back, but also make a bunch of money, right? So far, so good?
Yeah.
Well, that changed last year when the Treasury decided to start charging interest for all of these crazy loans that they were handing out. Now, these VCs said, whoa, pump the brakes. It's not worth the risk anymore. We need to go into real estate.
And that is specifically what caused Silicon Valley Bank to crash.
Correct. That's what caused the bank run.
Yeah. And
is this what it... Sorry.
Go ahead, Peter.
Go on, Mike. No, I was going to say, is this what it's like when I start talking about ad blocking to other people?
Wait, you were not following?
Well, so
I felt like I was really clear.
I know. That's actually what I was going to say, is it feels like kind of a dry topic. But it's... I think I do sound like you when you talk about ad blocking. It is so important for people to understand this. This is so important. Like, anybody who's frustrated about inflation, the economy, their wages, the way labor's treated, housing, it's all because of this stuff. Like, you really should be paying attention to it.
You have to be paying attention so that you don't get caught in the next 2008. If 2008 taught us anything, was that when we have unregulated markets like this, it's so important to keep an eye on things, because Silicon Valley Bank could have turned into the next 2008.
Okay. By the way, John, you were pretty clear, and I did kind of understand what you're saying, but it was more, and I should have said tracker blocking or data collection or whatever. The ad blocking is not actually that important, but the data collection, all that kind of shit really upsets me. And
I assume that's what you meant.
The comparison was partly it's a lot of jargon and a lot of stuff that I don't really understand, but also the kind of what's the word? The futility, the sense of like, what can I do? What can I do to stop this? This is an insurmountable problem. Like, how you're saying, people have to know about this to protect themselves, but what can they do? Like,
so there's a few things that you could do depending on where you think as an individual, right? Where you think you can be best protected. Do you think that you can be best protected by holding money in a bank account cash, stuffing it in your mattress, maybe in hard cash, or maybe putting it in alternative means, gold, silver, crypto? There are many
Bitcoin.
ways
Yeah, I was
to
gonna say that.
hedge against something like this. But crypto isn't
Yeah.
just sure. I know you guys are getting hung up on it, but there are so many different ways to protect yourself against. You could use bonds. You could use U.S. bonds to pay
Diversify.
out like 10%, and you are basically protecting yourself against like a bank running out of money.
But people don't understand this stuff. They need financial advisors, and that's something that scares people. I
Disagree.
saying,
I don't have a
yeah.
financial advisor. I've never asked a financial advisor about anything. I've just learned online for free. You just need to be good at Googling.
Okay, as in protection, like you use a pie hole and you don't have a financial advisor. I think you're an outlier in more than one respect, John.
But the other side of that, though, John, is yes, you can protect your holdings, but over and over again, in the long run, the market outperforms you.
Sure, for sure. If you're the coolest cucumber ever, and if you can sit through something like 2008, right? A number of people sat through 2008 and didn't pull out their investments.
In fact, kept investing.
Besides in like the companies that failed completely, like whatever it was, BlackRock and a couple others, but and kept investing every month, even into a 401k, right? Like even into a retirement plan. They outperformed the people who panicked and sold or bought or whatever. If you just kept on trucking, like nothing happened, you came out on the other side totally fine.
All right.
Yeah. There's more we could say about this. Oh my gosh, we've been going for 20 minutes already.
20 minutes.
Holy crap.
I could keep going.
So we're going to wrap it up. Tomorrow is going to be a fun show. I do wish we had more of a like climax to this episode, but I think I just wanted to highlight like
it's a good
how
article.
bad this really is.
Yeah.
and I feel like we can feel this in a more tangible way, even than like the privacy tracking stuff.
Sure.
Because everybody's affected by the economy. So fun show tomorrow. We will rally and have a good time. We will see you there.